Hello everyone, welcome to Price Action Trading Part 3. In the first two episodes, we have seen what is price action trading, what are the essential components of it, and in the second part, we have picked up two of the important concepts, which is how to draw a trend line and then what are demand zones and supply zones. So that's what we have covered in the first two parts. If you haven't watched it, please do check it out before you watch this any further. It sets the context for us to understand much advanced concepts that I'm going to discuss in this video. With that note, let's define what we are going to address in this video. There are four things that I am going to cover in this video. One is what is support and resistance levels, standard pivot points and how to use them. And then what are market gaps? How do we read those gaps? And there are events and news that could potentially impact the trend or the market in a way that beyond our imagination, right? So how do we go about all these four is going to be the crux of today's video. In line with this, I am going to discuss first concept, that is events and news. Events and news are so big drivers in today's scenario. There are many news that keeps coming every now and then, both in Indian market as well as in US market, European market, and the worldwide. Whatever has the potential to impact the global scenario is considered to be of very high importance. And there are also certain domestic, news that keeps coming in, and the impact is very regional. And it's essential that you understand and factor in events and news into your trades, because sometimes you carry a position assuming that it's going to be range bound or it's going to be some sort of bullishness or bearishness. But then when there is some news that triggers the market in counter direction, then you stand to lose almost like your life savings, right? So the risk is very high when you play positionally. In order to curb any sort of unforeseen or no negative impact into your portfolio, you should always keep some weightage to events and news. So how do we read this events and news? Basically, there are two ways to look at it. One, the real impact. For example, there is a company, some sort of scam has happened, some sort of complaint against the management whatsoever. Let's say that the stock is fallen by say about 10 percentage, right? This is just right after the news was broken, the stock has fallen 10 percentage. But then is that all the impact, the real impact? Maybe the real impact could be much worse than that, or it is the market has reacted too fast with the news. So that is the perceived impact. So there are two impacts. One is a real impact and a perceived impact. Whenever news comes, the perceived impact will reflect in the market so fast because there is fear, there is panic, and everybody perceives it differently. And once collective, sentiments is formed, and then the market takes it in a particular direction, the perceived impact rides it to a certain distance. And then market also takes time to understand what is the real impact of it, and probably the analyst and experts are further analyzing what would be the real impact. By the time the real impact is out, the perceived impact has already completed its trend. So let me give you an example. um, Adani was one good example of that. When the news broke out, what happened was that it was perceived to be so bad that the stocks crashed like anything, like close to 60-70% of its value was wiped off. But for the analyst and then the case to build for itself and to give the actual status of it, it took several weeks. And by the time it revealed itself, and then the reports were like not considered to have that great an impact, Adani quickly recovered its price back. right? So that is the real impact, but the perceived impact is how the market reacted to the news in the initial moments. That's the perceived impact. So we got to be aware of it. Even the news has the potential to trigger extreme volatility. For example, it was trading way above 2400, 2500, and then crashed as low as 900, and then back to 22, 2300 again. So that shows how much of volatility can happen even in stocks, right? Um, so even the news has the potential to trigger extraordinary levels of volatility, right? Um, then there is it also has the potential to change the long-term trend. Either if it goes correct, you will go big. If it goes against, then you may have to go home. What do I mean by that is, if you are holding a position, if you are on the right side of the trade, you make big money. If it goes against your position, then you might stand a chance to lose entire value of your portfolio. One of the critical aspects, as we discuss in this video, something that's going around is the Israel-Hamas war. It's quite sensitive. A lot of people are reading it in a different way. Right now, what we have is a perceived impact. Market is being very cautious at this moment. I'll show you an example of why I say that market is conscious about where it is trading right now, because the real impact would take time for it to unveil itself. Uh, when the news broke out, market immediately showed some 500 points of downside move, and what immediately followed was a 500 points move on the upside, leaving it very unclear. When the the conflict, evolved, everybody thought that the market is going to crash, but the very next day it bounced back, and then subsequently it was range bound and so on. As if this news doesn't matter, market kept playing in a tight range. I'll show you that. Now let's go and check the chart. For this video, I am taking the example of Nifty because I have been showing too many examples in Bank Nifty. Maybe this would be a welcome change for you guys. Like, let's go back in time to understand how the news plays out, right? October 6th, the market ended last Friday, and then Saturday there was a conflict between Hamas and Israel. The war broke out, right? And Sunday also the war continued. It became very intense. And Monday our market opened. When it opened, the immediate reaction was like, no, it's such a bad news. It fell down pretty much, close to like 200 points of fall has happened, and then it quickly bounced back. But at the same time, towards the end of the day, it closed towards the low, right? Now this is perceived impact, right? Then what happened was, maybe the market has reacted too fast because a lot of things are still unclear, and then market again retraced all the way back, right? Now what I'm saying is that it's not that Israel Hamas war is not so significant, that's why it is bounced back. People are unsure what would be the real impact of it. The crude prices were like going soaring up, and then next on Monday evening, the crude prices actually started coming down. So our market thought that okay, probably the impact is not there, and then it reclaimed. So there is some sort of confusion. It's going to be always like back and forth, right? And why I am showing you this is, let's check this out. This is the Friday close, okay? This is the interesting part I want you to have a look at. This is where it closed on Friday, right? Exactly here it closed. Now things are evolving, right? So it went up and then it came down, and you see right now it is trading over here, and the close was almost 19,650, and this is about only 80 points above, right? It's trading just where it was trading on Friday, right? Why it is, maintaining this range? It's because market is not clear how to read this impact, whether it's a conflict going to be regional or it's going to involve many other countries, and what would be the impact of those magnitude. People are still assessing, and things unfold, the direction would be picking up, right? So maybe if it's perceived to be a war situation and then it gets more intense, then we might see a crash. Or if market perceives this to be a very local thing and then the things don't get escalated, then probably we might see where the market goes. Probably it might be maintaining the range bound, you know in a tight range bound, or it might slightly continue to go higher as well. So we don't know the actual impact. The actual impact would be appearing to us as days progress. So that's the significance of news and events. It can change a long term trend, right? It has the potential to change a long term trend. So be careful. There were times like COVID. During the COVID time, market just simply broke. It didn't care about support levels, resistance levels, Fibonacci retracement levels, or demand zone, supply zone. Nothing was respected. When COVID broke, it was panic all around the globe, and market continued to crash without a pause, right? From 33,000, we have seen it falling below 15K. So that was the kind of fall that we had seen, and that too in matter of weeks, right? So news and events are extremely sensitive. You should always be aware of what's happening around you. The small news will have a very short-lived impact. For example, CPI data, or employment data, or any sort of RBI interest rates. These sort of news, positive or negative, probably it will have an impact for that day of the news, or maybe one day, yeah, to the very next day you might see the impact. It cannot be like going to drive for the whole month or whole quarter. It's going to be, the impact will be seen only for a day or two, right? But when the news is of very high degree, it's of national wide impact, industry wide impact, or global scenario is going to be redefined, like COVID, then the weightage given to events and news is extremely high, right? So, since there is a war like situation going on, we have to be very cautious at this moment. Even if you're carrying any positional trades, you should be extremely cautious of how much you are going to carry and how you're going to deal with things. So the next topic is market gaps. Market gaps are extremely important. One of the interesting things about market gaps is that it reveals which side the momentum is, and then most likely, if there is any sort of gap up or gap down, the trend is likely to continue in that particular direction, unless otherwise it finds a supply zone or a demand zone. That's where potentially there will be some reversals. Otherwise, any gap indicates a momentum, and the trend should likely continue in that side until it faces some support zone or resistance zone, supply zone or demand zone, right? Usually, what happens is when you see a gap up or gap down, say of around 200 points, it instantly creates a panic. Let's assume that most of the people don't carry positions overnight, and then you see a 200 points gap up. Would you want to really take a call position and then continue in that rally? You don't know, because market might reverse after you enter. You have a fear that it is 200 points higher, and what if the market falls down from there? So you will be indecisive. At the same time, people will be hesitant to take a put position also, because the market has already given a 200 points gap up. What if the trend continues, and you will be losing even more money? So people will be in a state of panic and wouldn't be reacting so quickly on things. They will be indecisive, right? It drives indecisiveness. And slowly, some sort of people muster courage and then, enter into small portions, and then they add positions after position over time. And finally, when there is enough indecisiveness candles formed, indecisive candles means you will find very small movement of maybe, plus 30 points, minus 30 points, or it will be trading in a very small tight range zone where people are taking more and more positions, and then there will be a final breakout or reversal, right? So market gaps actually is a very interesting concept, because one side, it is already given, somebody who has played positionally is already in a big profit or in a big loss, and then nobody is willing to do a fresh entry, and over time people are accumulating small positions hoping that it will go up or down. And once that happens, when the final breakout happens, it's going to be a massive move, right? So how do we read this? Whenever there is a market gap, it always, you will have to check back in time. Why this gap? Were there any sort of hidden details from the past that we are missing out? We got to always look for that information from the charts. So that's how you should read the market gaps. Now let's go to Nifty charts, and then I will show you how to make meaningful information of this market gaps. All right, we are again here looking at the Nifty chart. Here you can see almost every day we are having a gap up or gap down, right? You see there is a huge gap. There is a huge gap here, here again, and almost every day we had a gap since October 3rd, right? That's a very important thing to note. Why? When you observe this, whenever there is a gap, either it continued in the same direction, or it remained uh, skewed towards the same direction but in a sideways market sort of thing. For example, this is a gap down. Almost through the day it is more like a sideways market, but there is a huge gap that was never filled, right? The market never went back again to this levels, but next day they just came back. So what happened is, here is one gap that was formed, and the same gap was closed by another gap up, right? So gaps actually reveal momentum, and sometimes the gaps are also an indication of unfulfilled gaps from the past. For example, if you want to really see what has happened, I will give you a larger time frame example to make more sense. Yeah. Now, okay, here is one visible gap, right? Huge gap. Market, once it has taken this fall, it never came and then filled this gap. There are no candles, you see, there are no candles going and filling it. And then market went lower and lower and lower. And here also you see there is another gap, but then that gap got filled in the subsequent days. So whenever there is a gap, market would try to address it and try to close it in the same day or in the same week. And it will try to do it as quickly as possible. But then there are times where things don't happen the way that it is supposed to happen. Market has moved so far away from that gap, and under such situations, maybe weeks later or sometimes even months later, there are also cases where years later the gaps have been filled, right? So for this gap, you see it happened on August 2nd, and now you see how it got filled on September 8th. It took almost 1 month for the market to come back to the same level and fill that gap, right? So gaps actually reveal a lot of details. Now you see there is a huge gap up. Market went all the way up, and you see when it reached this level, the gap was filled by another gap, right? So basically, filling of gap is very important for the market to avoid unwanted surprises. If the gaps are not filled and there are too many gaps in the market, then we will see sudden burst of 200 points, 300 points move. Basically, you are not trading in that zone, but the market has moved. So it's going to be extremely rewarding or extremely punishing, right? If you're on the wrong side, it's going to be punishing. So gaps actually reveal some sort of unfulfilled uh, um, past data, right? Unfulfilled past data for which the market is trying to cover it up. Or if it is a fresh gap, then you know for sure that it will be filled in days to come or weeks to come. So watch out for all these things, because now this gap was filled by another gap, right? Gap down was filled by gap up. So it's fine. Now we have a gap over here, right? So very likely if the market tries to go up, it will try to fill this for sure. If the market is showing some signs of reversal, we know that it will likely to fill this gap, right? Very likely to fill this gap. And maybe if you're on the call side, you wanted to exit somewhere here itself, you can continue to wait. How do you use it in your trade setup? For example, the market has reversed and then it's trying to go up. Say that you have entered at 800 levels. Now market has gone to 850. You don't have to really exit, because there is a gap that's not filled. You can market very likely is going to attempt to close that. Maybe you can continue holding on to that position, or probably book off your position and then continue to hold off. So these sort of hidden pieces of information are there in the market that will help you to uh, make maximize your profits, and look for better returns, right? And this is something that you should try to embed into your trading systems as well, trade setups as well. So that's about market gaps. Let's move on to the next concept. The next concept that we are going to discuss is standard pivot points. This is actually an indicator. What it does is it computes the averages of high, low, and close, and then tries to find out where is the pivot, what are the various support levels and resistance levels. It gives you an insight into where the market is likely to find a reversal, or where it is likely to continue with the trend. Let me explain that in through a chart, but then the very essential part of standard pivot points is the pivot. Pivot is the place where market makes critical decision for the day, right? If the market is from the downtrend, if the market is coming up and then finds pivot at the top, find pivots at the top, it's very likely to test it. And if it breaks the pivot, then very likely that the trend would continue on the upside. If it gets rejected at the pivot, very likely that it is going to uh, go down. So depending upon where the market is trading and where the pivot is placed, we can find whether the trend is going to likely continue or reverse. And one of the best ways to use this tool is to map in both the time frames. For positional trades, that you should consider longer time frames like 15 minutes, like 1 hour or 1 day. And shorter time frame is excellent for intraday. So how does this work? Let me show you through the example of Nifty now. So here we are at the Nifty charts, right? So I'll show you how you can do this. Just choose the indicators. Here you see that there is standard pivot points. Just choose that. When you select standard pivot points, it's going to throw you a huge dump of data, right? It's too messy. All you need to do is that why it is showing so much. Let me explain that. Because the normal setting in Trading Wave is that it shows last 15 days of pivot that we are is been set. You can choose this. Maybe if you want to set it for last 5 days, then it just selects you and shows you only last 5 days of pivot. Now that is a very nice way to also do a color coding. I usually give black for the pivot, and support can be like given green. You just do the color coding, change it. And for resistance, I will give a red color or maybe pink. So let's have a look at this. This is in 1 hour time frame. Let me switch it to say 15 minutes, right? Now, what you got to really observe is look at this pivot. This is 13th Friday. Uh, uh, Pivot was at 19,803. Watch this. Pivot is at 19,803 in 15 minutes time frame. But when I choose 1 hour time frame, look where the pivot is now. Pivot is at 19,554, right? The pivot has shifted. So what does it mean? Positionally, the average uh, stands at 19,554. That's where the critical decisions in the market are being made, right? This is one important place where the market is finding a strong reversal or trend continuation. So in the longer time frame, pivot is at 19,500. In the shorter time frame, it is at 800. Why? Because it's going to compute the recent candles high, low, and close and do an average. Since most often the market has been sideways for so many days, it's computing all the averages and then the average comes to 1900 and 19,800, right? So that's why you see in shorter time frame the pivot is very close to where the market is trading, but in the longer time frame the pivot might be far further away. So if you're an intraday player or BTST player, what matters to you most is this 15 minutes time frame. If you're playing positionally, for example, month-end contracts or next month-end contracts that you play, and you want to know where the market is, whether the trend is likely to continue or not, then you should be playing at a higher time frame to read where the pivots are. And then there are likely resistances R1, R2, R3, R4, R5, and S1, S2, S3, S4, S5. These are supports and these are resistance. So this keeps changing for each day, right? And one of the things to keep in mind is look at how market reacted. So market gave a gap down, right? The first candle broke S4, but then the same candle it got retraced back and then traded above S3, and then it got rejected at S2, came down all the way, and then the moment it took an upward journey, it continued to go on, and as soon as it reached this point, reached this pivot, you see here is one rejection, second rejection, and then the market continued to reverse from that point. Now, this is where you can use it for your trade setup. How you can use it? Um, this is a likely uptrend. Probably OI data and all is suggesting uptrend. You can continue to hold. I mean, maybe let's say that you entered very late. You entered only in this candle, right? And the market has moved here. You got some good points. Let's say you collected some 20 points. Cool. Now, whether to continue to hold on to that or to exit the position is obviously a question that might be in mind. Maybe you can exit 50% of the position and then see what is happening, whether is it clearing this pivot. If it clears the pivot and then it continues to move, then the trend is likely to continue to the levels of R1. If R1 is broken, you know that it will likely to continue to R2, right? Similarly, each level, each barrier as it gets cleared, you have higher targets opened up, right? But here, this candle rejected it, and the next candle rejected it. You know for sure the pivot got rejected. So here you can probably exit all your positions, and you know for a fact if it is getting rejected, you know the trend is going to be downside. Maybe you can try entering it with the put side, right? So it not only helps you to protect your profits, it's also a way to find should we re-enter on the opposite direction, right? So this is how you can use pivot, and I hope that clarified. Let's go and learn the next concept. So this is the fourth concept that we are going to learn, and this is the final one. Support and resistance levels. Some of you might be wondering how it is different from, uh, you know, standard pivot points. It's definitely there is a huge difference because in standard pivot points, you're considering only the high, low, and the close of the recent, uh, you know, um, uh, recent moves, and then you're taking an average of it, and then the impact of it could be just limited to the time frame that you have chosen, right? And probably it is computing for last 2 weeks or 3 weeks, but that's not the actual scenario. And then it keeps changing. Like each day the pivot keeps changing. Each day the R1, R2, R3, and S1, S2, S3 keeps changing. So it's not something very fixed. It's more of being flexible, and then it reveals the data for the intraday purpose. Mostly BTST also you can consider if you're going for a larger time frame. Positionally also to some extent. But what really you got to keep in mind is it's not fixed. You don't know whether this point, maybe in the first example that we saw, 19,500, I mean, 19,800 was the pivot. Maybe tomorrow the market opens at 19,700, and already the pivot is somewhere else, right? So it doesn't really give you a concrete way to look at market and make meaningful sense out of that. For that intraday, it is good. But once that's broken and then there is a huge gap, all the previous levels are so useless. It doesn't make or add value. But standard pivots has its own benefits. But at the same time, we should also draw manually what are the support zones and resistance zones, and it will help us make some meaningful decisions because it is highly reliable. The validity is almost like permanent. You can, once you have drawn something, it continues to respect it for so longer period. And the beauty about this is what is support at one point may become resistance in future, and what is resistance today can become support in future, and vice versa. It keeps changing. So this support and resistance is more like a flex. It keeps changing as the market attempts to break and take a direction. So there are three important concepts that we will learn as we learn support and resistance levels. We will also learn three important techniques. That is, what is retest, what is reversal, and retracement. So let's go to the chart and learn all of these concepts to understand it much better. All right, we are back here. You see, let me hide the standard pivot points. And this is the first example that I gave. This line is before Hamas war was, announced, where the market was trading and where the market is trading right now. To keep a track of that, we have drawn this. It's not much important, but still let it be. What I want you to focus on is, let's go to a reasonably higher time frame like this. Okay. Here you see market has taken a good rally from here, continued to go up. It got rejected. Again, it made an attempt, got rejected. Again, it went up and got rejected. So almost around this level, it got rejected, right? See, please do remember, we have also done supply zone and demand zone. That is totally different from what we are doing right now. Although it might look very similar, please do watch that first part and second part to understand how support zone is supply zone and demand zone is different from support and resistance levels, right? So this is where the market got rejected. All right, then what happened? Let's try to find out. Market came down, took a support. Okay, all right, and market has come all the way from here. It has come all the way, and almost at this level, it took the reversal. But I want to understand if there is any reason why it got a reversal at this point and not anywhere else. So if I go back in time, I see that here is where the market has reversed. Here again it got reversed. Here again it took the momentum and then leaped up. So somewhere around this level, it's finding its support, correct? And maybe from the past, if I have to go back and see, these points are acting as a strong place of reversal, right? All right. So this point is acting as a strong support. Now, what else? If you see, again, market came here, reversed, came here, reversed. So this is one place the market has reversed. I'm going to draw this as well. Maybe this one I will give a different color coding because this is a point that has been flexed many times. For example, when it came down, this acted as resistance as the market went up. Again, it got rejected as you see, as it reached here, it got reversed. So this is one area where the market is finding its rejection. And the moment it broke, this one, the resistance turns into support. And how do I know that? See, when the market came back again, you see, it did not just like that. Having fallen so big, it did not just go here. What it did was to take a support, traded here for some more time. Again, it retraced. Again, it retraced. So this line acted as a great testing point, right? It did not just like that go down. It actually stayed here. And remember what is this line? The Hamas-Israel conflict. So almost these two are in the same levels, right? So you can see many different concepts coming together, right? You at one point the support has become resistance, the resistance has become support, and you are finding a great length of actions happening around these areas. Let's try to also find out few more rejection points. Where is the rejection point? Definitely this is a rejection point. So this is one resistance, and where the market is, trying to do many testing. See, if I extend this further back, you see, now you will understand. So there are a lot of data from the past. See, market tried to go down, then took support here, went up, tried to break down, again took a support, tried to break down, again took a support, and then it continued to rally. So the more number of times market finds a reversal or rejection is a zone to watch out for. So this is one area that the market is finding a lot of support. And as it see, it's valid for so long. Even after that, when the market came here, again it bounced back. So technically this 19,330 is going to be a strong support, right? So this is how you can play with the support and resistance levels. And these are almost fixed ones, right? Like you need to just visit it periodically, maybe monthly once, or fortnight once you can do this. But standard pivot points keeps changing every day. Every day it keeps changing. So the reliability of this is far more superior than standard pivot points, right? And what are the things that we had to discuss? Yeah, retest, reversal, and retracement. So one other thing is, what is a retest? Retest is, for example, the market goes up, it got rejected. Once it gets rejected, market will not straight away come down. Now it will try to make one more attempt to break it and then go higher, right? So if you're looking at some sort of resistance levels like this, market will make multiple efforts to break it, and that is called retesting. It is testing one more time if it can break and then change the course of the trend. But if it is not happening, then it gets rejected and then the reversal happens. Okay. So This is typically an uptrend. Market is trying to go up, but then got rejected. Again, it is trying to make a second attempt to go up, got rejected, so it came down. Right now, this is reversal. If the testing fails, then it becomes reversal. If the testing succeeds, then the trend continues. Okay. Um, and then one other important part to keep in mind is if a level is tested too many times, that level becomes weaker. This is another important part. For example, this is a support. If the support is tested once, twice, thrice, 4 times, 5 times, that's way too many times it's been tested. Very likely thing is that if it is tested too many times and people, big players would make some surprising attacking moves when it reaches here, because fourth time or fifth time they may actually break it and drag it so badly. In this case, probably this is also a support zone. It's a very sensitive number. Maybe 19,200 is very sensitive. Demand zone is there. That is from another charts that I know that there is a demand zone over there. So this is why it got filled and then it rallied up. But look at what happens in this case. First time it got rejected, second time it got rejected, third time it didn't even come here, it got rejected. But the fourth time it touched, you see, it just did not trade some 50 points above. It just broke and then rallied to a newer high, right? So whenever a level is tested too many times, it becomes weaker. That's another thing we should keep in mind. So what is a retest? What is a reversal? You should know by now. Then there is something called retracement, which will be covered in Fibonacci. Retracement is more like a Heben wave, right? There is no straight line up in the market or straight down line in the market. For every move that's happening, you see, there will be always some pullbacks. If there is a going up, then there is a coming down. If there is a going up, there will be coming down. Going up, coming down. These sort of pullbacks are called retracements. And if I consider this as the starting point and this as the ending point, now for this move, this is the retracement, right? Market always has to pull back to some distance in order to breathe, rest, and then run again. Okay, so retracements are those pauses that looks like some sort of reversal, but in reality, it is just taking some breath for the rally to continue in the same direction. So I will discuss in detail about Fibonacci retracement, and all this retesting and reversals and retracement will be covered in detail in the next video, and that will be the last part of the series. After that, I think we have covered everything about price action, the essential components of it, and covered each items, dedicating a part to that, and then covered. Once the fourth part is out, then all the concepts are covered. But what I'm also planning to do is to give some practical tips and suggestions how to embed them in your trade setup as a advanced concepts that I will keep adding. Maybe that will take some time, but for sure the series will continue in future as well in terms of adding real life practical examples and tips to strengthen your price action trading setups. So thanks a lot. Looking forward to see you all in the next video. Have a great day.